Good afternoon. Welcome to the business model of CDFI loan funds. This is our research report webinar. We are excited that you're joining us this afternoon. First, I wanted to mention a couple housekeeping items. We're recording the webinar and the recording will be available later on CDFI Connect and OFN's YouTube channel. We encourage you to use the chat function on Zoom to introduce yourselves, share comments and ideas, and interact with other attendees. We've allotted about 10 minutes at the end of the webinar for audience questions. So if you have questions that come up, please put them in the chat or the question and answer box, and we're going to answer them or try to answer as many as possible towards the end of the webinar. So next, I want to briefly introduce the webinar panelists. I am Adrienne Smtih. I'm OFN's Senior Vice President of Research and a co-author of the research report that we're going to be discussing today. Next is Clint Gwin, who is the President and CEO of Pathway Lending. They're a CDFI headquartered in Nashville, Tennessee. Next is Watchen, who is the President and CEO of Baltimore Community Lending, a CDFI that's headquartered in Baltimore, Maryland. And then finally, we have my colleague, Ashley Austin, who is a Senior Associate of Marketing at OFN. And when we get to the roundtable discussion portion of the webinar, I'm going to ask Clint and Watchen to say more about their CDFIs. Next slide. So this webinar focuses on a research project that OFN conducted, and excitingly, we're releasing the research project today, the paper. You can use that QR code in the bottom right-hand corner of this slide to access the report. So after this intro, this agenda overview, I'm going to spend about 20 minutes overviewing and discussing the research project and its key findings. Then my co-panelists and I will discuss the study and kind of do a question and answer between ourselves and talk about implications and paths for future research. After that, Ashley from OFN's communications teams will share tools that you and your CDFI can use to explain the loan fund business model to your stakeholders. And finally, as I mentioned before, we're going to leave time at the end for audience question and answer. Next slide. First, let's start with the research presentation. I'm going to start by telling you about the study's purpose, goals, and methods. And before I do all that, though, I want to start by telling you about how this research project came to be. Really, it was OFN's policy and communications teams. They wanted a study explaining the business model of CDFI loan funds to easily explain it to policymakers, the public, and stakeholders in loan fund leaders' own words. Because whereas people tend to understand what banks and credit unions are, that same can't be said for CDFI loan funds. So based on their request, we conducted a qualitative study of the loan fund business model. And now we are aiming to use the report that you just saw the QR code for and collateral to explain the loan fund business model to diverse audiences and new audiences as well. Next slide. So first, what the heck do we mean by business model? In the report, we define business model quite broadly as how loan funds operate and create value for their customers. This includes loan fund structure, how they make money, their mission and goals, and related elements. There is a particular focus in the study on how loan funds aim to drive impact by promoting economic opportunity and community transformation. Next slide. Me and my co-authors, we see three main contributions of the report. First, to closely examine the business model of loan funds. Second, to document the loan fund business model from the perspective of leaders, loan fund leaders. So we rely on data from interviews with 15 loan fund leaders, OFN members, to describe and explain the business model. We really want to center the voices, perspectives, and views of those loan fund leaders to paint a rich and detailed portrait of the business model. And the third main contribution is to present a series of case studies that illustrate how key themes connect to specific community development projects on the ground. So we try to address that but-for factor. That is, the case studies are of examples of projects that wouldn't have occurred without the loan fund's involvement. Next slide. So the report relies on data collected from 15 semi-structured interviews with OFM member loan funds, and we use those interviews to describe and explain the business model. The interviews took place in January and February of 2024, and typically we interviewed CEOs and in some cases, other organizational leaders. We aimed to select loan funds that represent OFN's membership writ large. So chapter 2 of the report goes through all those nitty-gritty details of how the report sample compares to OFN's membership overall. We do that comparison in terms of assets, financing activity, sectoral composition, and a host of other things. So after conducting the interviews, we made this qualitative code book to guide the analysis. We then coded interviewees' answers into thematic nodes, like kind of groupings, themes, and we used the codes to generate the report outline and write the report. Next slide. So now let's get into some of the report's key findings. And mind you, this presentation is just to whet your appetite. There's really a lot of content, a lot of qualitative content in the report, and we hope you'll engage with that content by reading the whole report or parts of it. Next slide. So this slide, if you take anything away, this is the heart of the report. It delves into the 4 components of the loan fund business model. And I'm going to start at 9 o'clock here, mission-driven lending. So the first component is ensuring access to capital through loans with a mission to advance economic opportunity and community transformation. So for each of these kind of pie pieces, I pulled out some quotes from the paper to show you. I just wanted to whet your appetite in terms of the types of stories and qualitative narrative that tie to each of the loan fund components. At 12 o'clock, we have localized focus. So really, loan funds serve as place-based lenders. They're seeking to catalyze change, build trust and relationships, and they want to support and grow local economies. The next one, development and capitalization. Loan funds work by raising and pulling together grants and debt capital from different sources. And the fourth component we have is technical assistance. So loan funds offer tailored, high-touch, culturally focused technical assistance at different touch points. And the goal of that TA is to build client capacity, to mitigate risks, ensure repayment, and then ultimately they want to achieve community development outcomes. So it's important to note that some of the interviewees raised other potential business model components. So these 4 components are ones that were repeatedly articulated in our interviews. And I also want to note that 2 features underpin the loan fund business model, and you see those in the circles on either side. One, loan funds are unregulated but subject to oversight. And secondly, loan funds operate as nonprofit. So although subject to certain oversight mechanisms, loan funds are unregulated, and that enables them to go deep in financing communities. So loan fund leaders and loan funds must adhere to relevant state, local, federal laws, such as various consumer protection laws. But they are also unregulated, and that allows the going deep in terms of financing. Secondly, most loan funds, over 90%, operate as nonprofits. Next slide. We kind of peel back the onion, so to speak, within each of the 4 components. That is, we use data from the qualitative interviews to delve into specific aspects, characteristics of mission-driven lending, localized focus, DevCap, and technical assistance. So, for example, within mission-driven lending, we explain how loan funds recycle capital into communities. They aim to fulfill unmet needs, and they lend across diverse sectors. Within that localized focus bucket, we unpack how loan funds catalyze change and really focus on building trust and relationships in their communities. In development and capitalization, we explain and explore how loan funds bring together money borrowed at low interest rates from various different sources. And finally, we examine several different topics related to technical assistance. So that includes like the purpose of technical assistance provision, like why it happens in the first place, the fact that technical assistance happens at different parts of the loan process, and related issues. Next slide. So during the interviews, we asked loan fund leaders what they see as the business model's core advantages and challenges, and we kind of bubbled those into different categories. So in the report, for each of the advantages and the challenges, we pull quotes and examples to explain these things farther. So you'll see like there's big tables of advantages, trade-offs, and like quotes associated with those advantages and trade-offs. So just to kind of bubble it up, some of the advantages include ability to advance mission impact, establish deep community relationships, respond to crises, both economic and kind of other crises, and then also to engage in partnerships and bring together community members. Trade-offs include that the model is resource and capacity intensive. Sourcing capital takes time, efforts, and specialized knowledge. The business model is influenced by the broader economic context, right, over which loan funds have little control. And a final challenge we talk about is that there's not enough sources for grants and low-cost long-term debt capital. Next slide. And I see a lot of pings going on in the chat. I just want to remind you, if questions come up as I'm doing this presentation, we do the roundtable, feel free to put questions that you might have in the chat or Q&A box. So we also asked loan fund leaders what, we also talk about kind of flexibility in financing, because practitioners and partners often describe loan funds as flexible lenders. But the term flexibility, different people use it in different ways and understand it in different ways. So we really wanted to understand what that flexibility is, why it's important, and how it works on the ground. So as this infographic shows, loan funds implement flexible approaches to underwriting, to structuring their loans, and to servicing their loans. So during the underwriting process, they seek to maximize impact and broaden capital access. In terms of structuring loans, they want to structure them in ways that meet borrower needs, promote that repayment, and ensure impact. And finally, loan funds are often thought of as patient lenders that provide support throughout the life of the loan. Next slide. So we then explore specific flexibilities throughout the financing process, from underwriting through servicing. For example, so we have these tables where we have different sample flexibility, and we associate those flexibilities with quotes and anecdotes and examples of how the flexibilities play out on the ground in loan funds. For example, so in the underwriting bucket, loan funds, they often take a project first focus and mindset, use character-based lending, and use different types of appraisals and real estate deals, among other flexibilities. And so, like for each of these bullets and some others, we give quotes to illustrate what the flexibility is and how it works in practice. In the loan terms bucket, we explore things like early periods of no payments or interest-only payments, lower interest rates, and minimal or no collateral loans. And then finally, in that servicing bucket, Loan fund leaders talked about their work as patient lenders. They provide support and options throughout the life of a loan, including when repayment is at risk. And I just want to reiterate that in all three buckets, the flexibilities aren't exhaustive. They rather illustrate the types of flexibilities that loan funds employ. Next slide, please. So in the next chapter, we explore the ways that loan funds aggregate capital and grants relative to their business model. And here, again, I wanted to show you how the richness of the qualitative data that we were able to gather and how those quotes and ideas and examples associate with some of the themes that we raise in the paper. So starting at 12 o'clock this time, in terms of development and capitalization, loan funds often aim to align with their development and capitalization approach with their mission and strategy. They want to seek out funders and investors whose mission and strategic goals are aligned with their own. At 3 o'clock now, low-cost loan fund leaders aim to raise low-cost and long-term capital from different sources. And most loan funds want low-cost long-term capital with few restrictions. Loan funds use grants to lend at lower interest rates and also to build borrower capacity and to take on risk. And finally, loan fund leaders see their relationships with funders and investors as partnerships through which both parties can achieve goals. So it's like mutually beneficial. Next slide. There's a lot more to cover in this report, and I wish I could talk about it, but I want to also save time for the discussion with my co-panelists. So you're going to have to read it or read parts of it, like the executive summary. I want to end by presenting some of the implications of the study. The paper's conclusion also has proposed topics for future research. As a researcher myself, of course, I'm interested in extending and expanding the research. So we take that up in the conclusion. Next slide. So implications of the study. Policymakers, and we kind of bucket it out into policymakers, funders, and investors and practitioners. So we say that policymakers at all levels of government should develop more programs that leverage the loan fund business models. We want them to enhance their understanding of the business model and develop creative solutions to maximize the business model's benefits. Funders and investors should deploy and design long-term, low-cost patient capital that works for loan funds. And there's this need to pair the debt capital with grants to support operations. And finally, we think there's certain vulnerabilities in the loan fund business model. And we call for practitioners to develop solutions that address the business model's vulnerability. And leaders and practitioners should evolve and strengthen the business model to weather headwinds while remaining deeply rooted in their communities. Next slide. And I do want to pause here so that the paper, it's in the chat, and there was a QR code where you can click to download it. I want to mention that the report is co-authored with me and my colleagues, Alexander Carther and Brent Howell, and we look forward to, thank you for putting it in the chat, colleagues. So we look forward to folks reading it and commenting on it and getting in touch with us about it. So I want to open it up. I'm going to invite Watchen and Clint to come on camera, and we'll start the roundtable discussion. But first, Watchen and Clint, maybe first Watchen, can you tell me a little bit more about Baltimore Community Lending, what your focus is, and kind of just an overview of your CDFI loan fund?
Okay, great. Thank you very much. I'm Watchen Harris Bruce, as was stated. I'm with Baltimore Community Lending. We are a CDFI in the Baltimore region, and our CDFI has been around for 35 plus years. We are focused on the Baltimore region, but we are dedicated to helping low-income communities that have been disinvested for many years and need access to capital, technical assistance, and other resources to be able to access traditional banks. So our mission is focused on revitalization and access to capital for entrepreneurs. We our organization is focused, we have two loan funds. One is focused on small business lending, where we provide capital to startups and existing businesses. We are also a SBA micro lender and community advantage lender. And the other loan fund, it's real estate. We do affordable housing, both home ownership and rental units, and commercial real estate. But the third line of business is our Business Development and Resource Center. We have this center to provide comprehensive end-to-end technical assistance, because we strongly believe capital plus business development services is very essential to the success of any entrepreneur that needs to grow and expand to access commercial capital. So those are the three lines of business that we have. And thank you for the opportunity to be here today. Thanks.
Adrienne, thank you for having me today. Clint, Gwin, Pathway Lending. We celebrated our 25th anniversary this past year. We primarily focus on small business lending ranging from $5,000 to $5 million. We also do affordable multifamily finance and sustainability lending around energy efficiency and solar. Like all CDFIs, we have a very robust, we call it capacity building program, to help our entrepreneurs and the folks that we work with to build their capacity to build and grow their businesses. So thanks for having me today.
Thank you both for joining me. So we're going to dive into our roundtable discussion. So you had an opportunity to read the report, spend some time with it before the webinar. I'd love to hear your feedback on it. What does it do well? Where and how could it be improved or expanded upon?
Well, I'll start there. But first, congratulations. This is an excellent report, because the report started off with just explaining in plain language on what a CDFI loan fund is all about. Many people do not understand CDFI, and they do not even know what CDFI is. For those listening, it's Community Development Financial Institution. So we always use acronyms, but first we have to define what a CDFI is, because not everybody understands. And because we always use the word technical assistance means different things to different people. So, but the report really explain what all of the services are. And I think the great part of the report is the 4 core points, which is who we are. We are a mission-based lending institution. We focus on the social aspect, but we are not charity, but we are lenders who care about people. Secondly, we are local. We create relationships and trust, because people lend to people they like. I'm a former banker myself. If you do not know the customer, it's difficult to lend to them. So we build trust because we are all local, and we get to know our clients. They are our friends, they are our neighbors, and they are part of our community. And also the third one, development capitalization. Without capital, we cannot lend, because we need patient capital. And so that explanation was great for people who do not understand the industry. That's a great explanation, because people always ask, where do you get your money to lend? So that is very helpful. And last but not least is the technical assistance. Just explaining what technical assistance is helpful, because most people do not use that word. It's our industry special word, but it is really capacity building and mentoring and coaching and training, all into building the capacity of our clients. And the goal is for them to go out and access conventional financing. So the strength for me is the 4 components that you are started with. And so thank you. And that's it for me.
Well, Watchen, I think you touched on my point that I thought was extremely well done in the report, which is the technical assistance piece and really walking through that. One reason I believe that's a huge differentiator for our industry, both on the side of people who provide uh, services like that, like SBDCs, but also from the financial institutions, as CDFIs are the only place where those are both combined in one organization. I think the other place that is important to talk through is the development of capital and the capital resources that are gone through in detail in the report, laying out where we all get our capital, how that capital is aggregated. And CDFIs do amazing work in bringing disparate capital sources together to really create mission impacts at the end of the day. I will say, I think we talk a lot in the report about impacts, and I think that's one place where there could be some more definition around what impacts are. With regard to, we do a lot of outcome-based impacts in our industry, jobs created, units created, but what are the outcome-based impacts that we're working for? So that might be a place as you move forward in your research to look at that impacts on the outcome versus outputs side of the table.
Yeah, I couldn't agree with that more. I think there's a continuing need to refine and level up in terms of impact reporting and measurement. So in the report, we also talk about certain vulnerabilities or trade-offs of the business model. Some of the examples are like that it's resource and capacity intensive. The work is always subject to the broader economic context. And then some other things that we talk about. So as practitioners, where your day in and day out is the loan fund business model, how do you think we can best address these vulnerabilities, especially as we aim to scale and grow individual CDFIs and the industry writ large? How do we address vulnerabilities?
Well, I will start with that. I mean, it is a major challenge on how to solve it. I don't think any one CDFI had determined how to solve the vulnerabilities. But because, for example, we talk about technical assistant capacity billing, but there's no resource to cover the costs. It's labor intensive, capital intensive. We make money from loans, fees, and interest, but it's never sufficient to take care of operations. But capital plus technical assistant and business development, I mean, they are very important to success of a CDFI, but how do you cover that cost? It is still a secret. So we are still learning, and we hope to find that out, because most funders will give you capital, but they are not willing to give you resources like grant capital to cover the TA or the training or technical assistance. And that's something I'm still trying to figure out how to do. If they do give you grants, it's very restricted. So what we need is ready to find unrestricted capital to solve that problem. So maybe Clint may be aware of that. I don't. I'm still trying to figure that out, because we don't have the answer. And so we are trying to diversify our funding, but it's very difficult to cover that cost. So.
Right. And I think the other vulnerability, I completely agree with you, Watchen, with regard to the providing the deep, costly resources that CDFIs really all want to provide to their communities and their potential clients and clients. The other piece of that vulnerability, I think, is that of net assets and capital. As organizations start to try to grow, getting net assets, there are very few places to obtain those net assets. The CDFI fund being probably one of the most obvious foundations. We've had some pretty good luck with collaborations with state and local government to be able to help build net assets to expand impact and expand reach. But I'd look at it as the 2 points that I see most creating vulnerabilities, which you outline well, are the ability to fund the technical assistance and the ability for CDFIs to grow with so few sources of net assets available to them to build their balance sheet to then bring on more capital. And y'all do a nice job talking about both of those.
Yeah.
And now is to use it to solve for those problems. So we also, it's not just about the downside, it's about the upside. We talk about advantages of the business model, such as like the pure focus or a strong focus on mission impact and the ability to respond to crises. So how can we best maximize these advantages? Like what kind of strategies can we build or use to take advantage of the business model's strength?
I think as y'all illustrated in the presentation, one of the strengths, but also one of the weaknesses of the business model is the unregulated nature of CDFIs. I spent the first part of my career as a bank regulator at the FDIC, so I understand that side of it very well. But I think it is the unique nature of this hybrid entity between a venture capital fund and a traditional bank that is putting capital to work in markets that historically don't see it. It's hard to regulate that entity. It's very hard to regulate venture capital, easier to regulate financial institutions. And so the unique nature of that unregulated risk taker carrying more capital puts CDFIs in a unique position to be, I've heard it said many times, the first responders to crises in markets, and the first ones to go in and try to develop new markets. A lot of the markets that traditional banks lend to these days were created and proven by CDFIs. Going in there first, showing how it can be done, doing it profitably and consistently, and then financial institutions move in. And that's part of our job as well as CDFIs, is to make other lenders aware of the good business opportunities there are in these underserved communities. And I think that's a key point that y'all did bring out in the unregulated nonprofit. I would argue that I'm pretty well regulated. I have 45 lenders that, they're under the hood constantly trying to see what we're doing and making sure they're going to get their money back.
Yeah. Yeah, well, just to add to that, I agree with what he just said. But I think one of the major advantage, as you say, is to advance mission impact. But we still have to explain what that means, because impact is different for everyone. A traditional lender is not focused on impact. They focus mostly on profitability. But we also want profitability, but we want to transform communities, transform lives, and grow entrepreneurs to become, big businesses and create jobs. Because if we don't create jobs for these small businesses, our community will not survive. So we have to learn how to create partnerships. It's all about forming collaborations with investors, with other partners like the financial institutions. And like I tell the financial institutions we work with, it's not about CRA or being regulated, it's about good business. But someone has to fill that gap, the gap between what we do, and that's what distinguishes us as a CDFI from a commercial bank. We create or fill that gap that a bank that is regulated cannot go in, but we prepare the borrowers or our customers to prepare themselves to become bankable, because they may not have the perfect credit, they may not have the asset or collateral, or the kind of balance sheet that a bank needs to make a loan. So we are there to help prepare them. So we need the investment, patient capital to help mitigate that risk. So for us, I see us as a credit enhancement and a bridge bidder. So we have to create partnership and as well as respond to emergency, like the PPP that happened a couple of years ago. We were able to jump in and help solve some of those problems that a financial institution couldn't do. So we are there to solve a crisis whenever the fire is on. And that's what we do day in, day out.
Yeah, thank you. So like to back up to Clint's comment, I'm glad you raised the like unregulated but subject to oversight. And I presented an earlier iteration of the paper at OFM 40, and the audience really like took up. I appreciate the audience really digging into that because we like got very, as a result of that, we got really careful about the language we were using. And like, yes, what does unregulated but subject to oversight mean? You'll see a box in the report about we're kind of digging into like the subject to oversight, like from investors, from certain consumer protection laws, and really understanding the yes, unregulated, but and kind of like having our cake and eating it too by unpacking that.
Without question.
So yeah. So the report, we're really aiming to speak to like new stakeholders, existing stakeholders, industry partners, really focused on the policymakers and funders and investors. What do you see as the report's main takeaways for those partners? Like, more importantly, perhaps, what are the implications for how policymakers and funders and investors show up to work with loan funds?
Well, I'll start on that one if you don't mind. So in the report, you've got exhibit 3.3 and 3.4, advantage of the loan fund business model and, challenges of the loan fund business model. I think that really lays out a map and a framework for explaining the benefits of working with a CDFI revolving loan fund, but then also asking for the resources that are needed to make it work correctly. And laying it out the way you all have done it in the report, talking about the advantages, but the challenges at the end of the day to the work we do and the capital we need and the capitalization we need was done very well and should be a guide for all of us to look at when we go to funders and say, hey, we do all of this really well. We can do more of it if we had these resources, which are outlined in 3.4. Around the challenges or the trade-offs of the loan fund business model, which includes, I'm glad y'all included this at the end, which was recruiting and retaining talent in the CDFI fund industry. We do a great job in our industry of training future bankers. And so we've got to continue to do a great job of retaining them. And that takes a number of things. It takes benefits, it takes salary, and all of those things are where we're competing with the regular market.
Yeah. Yes, and to add to that also, I think in terms of one of those is this about stakeholders. This is a Python report to educate and inform and bring about awareness, because there are a lot of bankers. I was a business banker before coming to a CDFI. There are a lot of business bankers who do not understand CDFIs. They do not understand because it's a specialized field. You really have to have a passion for doing this, and you have to work a lot harder to structure the deal and like people, because bottom line is you have to really help to structure the deal to make it feasible, financially feasible. And so educating our stakeholders on all what it takes to make a very strong portfolio is all of these mitigation that we have to do. The training, technical assistance, coaching, consulting, and everything put together helps to make the barrier a strong barrier. And so our stakeholders, including the investors and lenders, need to understand that we need flexible financing below market, as well as longer patient capital to make this happen. Because without that, and not just the lending capital, we need grant capital, because we cannot generate enough resources to cover all of the soft costs that goes into producing a great portfolio. So the stakeholder needs to understand what it takes to be a great CDFI or a lender or mission-based lender. So informing them is great, as well as educating them. And it may take just one-on-one, educating them themselves, both the policymakers and our investors.
Thanks for that. So, my OFN's research team, me, my colleagues, Alex, Brent, and others, We really want to do research. We're aiming to do research that builds knowledge about and for CDFIs and our members in particular. So with that in mind, like how can this study be extended or expanded? What are the most important areas to conduct field building research on the heels of this report?
Well, I would start on that. I think on the next step, research would be great to talk to our borrowers to find out why do they come to us, because they are a major stakeholders. Without people needing the product and services, we wouldn't have clients. So it'd be great to interview and study or have case studies of why people come to us. Because we have people that come to us who are bankable. And we ask them, why will you come to us? And they have strong balance sheet, have strong credit, have track record and collateral, but they come to us and we ask them, why do they come? They said because of the relationship. Some people still want relationship banking. They want to know that their lenders. They want to have the ability to talk to people instead of a 1-800 number. So it's so many reasons people come to a CDFI, and they want to be local, not just a national firm. So it all depends. Everyone has different preferences. So doing further research, future research with stakeholders that includes funders as well as investors, policymakers, and clients would be very great, because all of that would give us a bigger picture of why this product is needed or this model is needed.
Yeah, I'll piggyback on Watchen a little bit. We did some research, thanks to some funding from the Carsey Institute, that one of our teammates presented at OFN 40 as well, around why our investors, our stakeholders, put money with us. And I think getting a broader spectrum of understanding, I mean, we did a small kind of survey, if you will, and some interviews of some of our Pathway Lending's investors and stakeholders, but really understanding the broader market so that all of us in the market can start looking maybe at different funders. I'll be the first to admit we've never had any religious funders at Pathway Lending, and I know a lot of CDFIs have had a lot of luck with that. I don't know what the pitch is from that perspective, and so I think looking at that is one piece of the puzzle. You outlined the increase in lending by financial institutions that began in 1994 to CDFIs, coinciding with the 30th anniversary of the Regal-Neal Act. But that's also coinciding with the revisions to CRA that created the CRA investment test. And so what we found in our research was that the regulatory environment was an impact on financial institutions, at least, participate. I still see a huge gap in understanding how we can get more non-financial institutions participating with CDFIs and research around that. We had good success. OFN had great success previously with Starbucks, trying to raise the profile of CDFIs nationally. I think there's some opportunities for some research around there about why those companies choose to participate with CDFIs would be very helpful.
So as we're wrapping up the roundtable discussion part, Clint and Watchen, is there anything else you want to say or mention or raise about the research, and any final comments on the paper or future avenues or things, just comments?
I'll let Watchen go if she has something.
Well, just lastly, I want to thank OFN for being a champion, because without OFN being our leader in this industry, I don't think our constituents or our stakeholders would get the kind of education they need. Because in order for this industry to expand and grow to meet the needs or goals and objectives, we need organizations like OFN that help its members. And membership has its privileges. And I can see this is a privilege for us to be members of OFN, to be able to have passion to share with everyone globally who we represent. We are here to help people help themselves, to create wealth, but we couldn't do it without OFN helping us, showing us how to do it, as well as helping us with resources. So we want OFM to go out there and get more resources because we are a growing industry and we need more money. So please get more grant capital and as well as education pieces, pieces like this research document, because with the data, people will understand mainly the capital market. That's where I want us to be one day. We want to be able to borrow it on the capital market like any financial institution and not wait to just get chicken change. We need real money. So help us get there. So thank you.
Thank you, Watchen, for the compliment and the call to actions, and yeah.
Yeah, I thank you. That puts me to work again there, Watching. Yeah, I think the research aspect is important, especially as we go through this current environment that we're operating in. Being able to show hard research of the results and the impacts and the leveraging of public and private dollars. And anytime we can continue to show that to our stakeholders, I think we as an industry are a very, very good investment opportunity for them. And at the end of the day, they're choosing one investment over the other. And if we want low cost capital, we have to add other things to that investment model that show a bigger return on investment than just the interest rate.
Yeah.
Thank you. So now I'm going to hand it over to Ashley Austin, my colleague at OFN, to talk about the communications tools. And I'm going to ask Clint and Watchen, they can go off camera, but stay on the webinar so that you can participate in the Q&A. Ashley?
Can everyone hear me okay?
Yes, sounds good.
Okay, perfect. Okay, so I'm gonna talk about communications tool, but mainly social media and how to use the two-pager to educate, engage, and diversify our audiences. So next slide. So first, why social media, right? So social media is a tool to educate, engage, and expand our reach beyond traditional networks. Many stakeholders, so investors, the policymakers, our community leaders, and CDFI borrowers are already on social media. So meeting them where they are increases the visibility. Social media can also help demystify the CDFI loan fund model for audiences who are unfamiliar with it. So pairing social media with the two-pager and the full report ensures that different audiences can access the level of detail they need. So use the two-pager. So like break down the key points from the two-pager into digestible social media posts. And on the next slide, I'll give you a couple examples of how to do that. Turn some of those key insights into graphics, carousels, or short videos. And leverage storytelling. So in the full report, there are like bite-sized case studies of borrowers who have gone to a CDFI loan fund and how that money has helped them do things within their business, right? So without the CDFI loan fund, they wouldn't have been able to bridge those gaps and fulfill those needs that are needed in rural, native, and urban communities. So it's always nice to share real stories of businesses, communities, or individuals who have benefited from a CDFI loan fund. And then always mobilize your network. So always have that last call to action, like download and share the two-pager within their networks. Use some of the social media posts that I'll have on the next slide to amplify the message. Direct your different audiences to the executive summary, the key findings, and infographics for a quick and meaningful takeaway, and tag those relevant organizations, whether it's OFN or some of the CDFI loan funds that are mentioned in the report. Next slide. So some strategies for using social media. So like I said, like share those key takeaways in bite-sized content, break down the key points. You can have a tweet like on the top right-hand corner that says like hashtag CDFI loan funds are mission-driven lenders providing flexible capital to underserved communities, and learn how they work. And you could either link it to the 2-pager or link it to the full report. You can create engaging visuals by taking screenshots of some of the graphics in the report or the 2-pager, and you could create carousels and some simple visuals to illustrate how capital is recycled, what mission-driven lending is, and some key benefits of loan funds. And then, like I said, like leverage that storytelling. So share those stories that are within the report and the 2-pager. So my call to action is just to encourage you all to download the 2-pager, explore the full report, and use the executive summary, key findings, and infographics to engage different audiences.
Thank you, Ashley. Thanks for
course.
highlighting the ways that this research can be used. And I'll ask you just to stay on camera in case there's any questions from the comms side of things. Watchen and Clint, would you also mind coming on camera again? Thank you.
Okay.
So we do have a number of questions. We'll get to a couple of them. If there are questions after the webinar, my contact information is available and in the report, you can share it, and feel free to reach out to OFN about the research. So one of the questions that we got is for both of you, Watchen and Clint, for CDFIs that provide TA, maybe can you tell us a little bit about your TA approach? Like, do you train lenders to provide that technical assistance, or do you hire and contract with outside TA providers outside the lending department? Maybe you can tell us how it works in your CDFI and other approaches that maybe you think are promising.
Okay, sure. I'll start. When we started our small business loan fund, we did contract our TA to other business development service providers in the community. But then it didn't really work out well because these organizations did not have the capacity to meet the needs of the clients. It was taking very long for them to schedule appointments, and people would come back to us and complain that they couldn't get, appointments for the TA. So what we decided to do is bring it in-house because we could control our pipeline if we manage the TA. And our TA is done now in-house. We have like 3 full-time TA providers that provide coaching, training, mentoring, capacity building. And the reason it's important for us to manage it because it is a requirement for them to access our capital. We provide loans from low as 10,000 up to 150 for micro enterprises, and we also do real estate. But the point is, because we do not require collateral for our small businesses, so we require them to go through our technical assistance or one-on-one coaching. So to manage that process, we had to bring it in-house. But we still work with other collaborators and other partners. We are developing a business development and a resource center. And that resource center will offer end-to-end comprehensive technical assistance or capacity building. It's going to be more than working on business plans or financial projection or cash flows. We're going to be offering marketing as well as legal services, insurance, everything that a business needs to grow from startup all the way to succession planning or exit strategy. So our resource center will be managed by partners. So we are going to use other professionals that will be part of our consortium to help provide business development services. So that's why we decided to do this as a separate line, or so to not have our lenders tied down in doing TA and not being able to lend. So those are separations of duties. Our TA providers are not lenders. And our lenders do strictly lending. They take over from the TA providers after we get them, the clients ready.
We're similar to Watchen. We have 7 business advisors on staff that do primarily post-loan technical assistance. We do some pre-loan, but most of it's post-loan. Really tried to help build the capacity of the business.
Yeah. Yeah, we do pre and post also. Yeah.
So there's another question. There are a lot of really good questions. I'm sorry we won't be able to get to more of them. There's a question, is one of the answers of how to address vulnerability to do more research on CDFI work in particular communities, like how the CDFI played a role in economic development or trends in a particular area. And I think, yeah, yes, absolutely. 2 thumbs up to that one. I think in this paper, what we sought to do is describe the loan fund model, business model in general, but there are particular nuances to how each loan fund works and the specific impact that they have in their individual communities. I'm really encouraged by the growth of the CDFI research community, partners like at the Fed banks, at the University of New Hampshire, Urban Institute, a lot of different partners who are working on how to study, and OFN, on how to study the impacts of particular CDFIs in particular places. And I think there's increasing venues and avenues to do that. But for all of you engaging in that good work, I'd say, like, let's keep going, let's keep working on this.
It's been very important to us, Adrienne, to do actual research studies on our specific programs. And that has paid tremendous dividends with our stakeholders and them understanding what they got for their investment and the outcomes that we're achieving. But I think it's also going to be very important as depending on what happens with CRA going forward, if that is a driver of investment decisions for financial institutions, having valid data that is independently done for the regulators, I think is going to be an important asset for CDFIs.
Well, I really thank everybody for the wonderful questions and engagement with the research this afternoon. The report link is in the chat. You can access it through the QR code. Just to clarify, you do have to put in your email address, your contact information in order to download the report, but I really encourage you to do it. I think that's well worth it. And we look forward to continuing research and continuing engagements with topics like this. Thanks so much for your time this afternoon, and OFN looks forward to seeing you on a future event soon.
Thank you.
Thank you.
And thank you to my co-panelists.
Okay, thank you.